Do you share your colleagues' discontent? This about the equity markets.
Well, good morning, Tom. Good morning, all. The discontent in the economy may not necessarily mean discontent in the markets. I mean, as you know, markets trade differently from the economy. And look, we are looking at a slowdown for sure as the case counts rise, potential lockdowns, and all that good stuff. Look, while the S&P 500 is basically flat since early September, there's a raging bull market going on under the surface. This is the point we've been really trying to emphasize, that as we look forward to next year, there's still a lot of undervalued assets within the equity market that hadn't participated yet, and that's the big story that's really going on in the equity market.
Is it absolute or relative? Do you unload your tech to go over to materials, cyclicals, banks, and the rest, or do they participate as well?
Well, we did that. I mean, that was the strategy. I mean, you guys were talking about stepping into the fray back in March, being difficult. I think it was even more difficult to kind of move away from the former leaders to the laggards, right? That's a real career risk for a lot of people, and I think folks have fought that as long as they can. And now it's becoming apparent that they need to consider that move. And that's what the last 3 weeks is really all about. The combination of an election result plus the vaccine news is now forcing people to consider the possibility that this leadership change is not temporary, that it's actually more sustainable, and positions and portfolios are just not ready for that.
Capitulation. We've got two time frames here, Mike. You and I have talked about them so many times, the near term and the medium term as well. You've had this trading range that you've developed, and it's evolved slightly as the year has progressed. Mike, can you walk us through that range right now and why you think we might be in for a test at the lower end of that range?
Yeah, I mean, trying to call corrections in a bull market is sometimes a fool's game, but sometimes it makes sense. So obviously, as you know, we were extremely bullish from March through basically August, and we then thought the market would go through some consolidation, and we threw out this range of 3150 to 3550, which was technically driven. Now, that worked really, really well from basically August through the end of October. We made a trading buy call at the low end of that range right before the election. That worked out really well. And now we're up at the upper end of that band again, actually through it. We're at 36.35. So, we're going to be objective about this. We're not going to get dogmatic about some trading range. But look, at the end of the day, John, at 36.35, you've baked in pretty much as much upside as you can legitimately sort of confirm with fundamentals, okay? The technicals are one thing, but also on a fundamental basis, it's hard for us to stretch it much beyond that. You have liquidity, maybe surging in the market that's taking things higher, but our job is to tell our clients when the risk-reward is attractive. And right now, the risk-reward is much less attractive than it was 3 weeks ago. It doesn't change our view about the bull market extending into next year. And once again, the main message we want to leave with clients is don't focus so much on the index. Let's find the opportunities that are clearly in a bull market. And as you were talking earlier in the show, I mean, the Russell 2000 is up 20% this month, and it's just starting to have relative outperformance. Those are the types of things that we want to focus on for clients.